Hello everybody. So in this video, I wanted to run the Magnificent 7 stocks through my usual spreadsheet, enhanced also with what I call the value-oriented metrics, which, most value investors actually are pretty cynical about things like EBITDA, but to me, that would be my value-oriented metrics because I consider them much better assessments of the firm's cash flow than, say, earnings. So when we look at the stocks, and if you're interested in just my spreadsheet and the way I use stocks, feel free to stop. But when we look at the stock, the first thing that I look at the spreadsheet is the growth. What I care about is I want my stocks to grow at least 30% revenue growth each year, and preferably for a decade plus. And that's why Tesla, for example, we know that Elon Musk has guided for a 50% increase in deliveries, which if you add all of the miscellaneous business and if you add FSD take rates, if you add to that, you should reach, in my view, about a 50% revenue growth each year until 2030. And so that's why I'm very happy, very confident to put 50% revenue growth going forward. Business that's growing very fast. Now, NVIDIA, I put 80%. That's kind of my assessment of where they're headed on revenue growth in the next 12 months. But some analysts predict that it will be well over 100% of revenue growth over the next 12 months with the AI boom. So we have this level of uncertainty. But even taking 80% for NVIDIA and 50% for Tesla, what we get is that two of the Magnificent 7 stocks, Tesla and NVIDIA, in my view, are much, much more attractive from a growth standpoint than the 5 legacy FANG stocks, which are Apple, Microsoft, Google, Amazon, and Meta, formerly known as Facebook, because these stocks, Apple predicted 4% growth next 12 months, Microsoft, Google, Amazon, about 10% growth, and 8% for Meta. All of this is below monetary inflation. I view monetary inflation as 15% over the long run. And so, you would hope, in my view, if I were to buy these stocks, I would hope that the growth reaches past 15%, breaches that 15% threshold in order to at least keep up with monetary inflation. This is why I consider I'm going to call them the FANG, or the Magnificent 5, those 5, I consider those more of savings account type stocks rather than I consider them hyper growth stocks. They are not entirely hyper growth stocks in my view. Now, the question is, how much am I paying for growth? This is how I kind of assess on this channel whether I find a stock overvalued or undervalued. And I try to get my stocks around a 0.5 for each percentage point of future growth. So when I look at 3 companies that are Tesla, NVIDIA, and Amazon, I find these companies adequately priced for growth, because it's true that for all of them, even Amazon, you're paying just a tad more than my number of 0.5 for how much am I paying for each single percentage point of growth. Like ideally, I get around a 0.5. I'd like to get that, so I'm a little higher on these stocks, but it's worth it in my view because these stocks are some of the highest quality companies out there, and they've had some of the best compounded returns out there. Premium quality stocks typically tend to trade at higher valuations for a very, very, very long time. It can last multiple decades. You can have a stock with a premium valuation for 5 decades. So they are standout in the way that I look at valuation. I find them relatively cheap, and that is Tesla, NVIDIA, and Amazon. And I know it sounds crazy to say, for example, that NVIDIA is relatively cheap. I know it sounds crazy. But if you actually predict 80% growth, it's not that expensive. If you predict 80% growth, it is not that expensive. On the other hand, a stock like Apple, for example, I see it as extremely expensive because it is not growing anymore. There's not 4%. It's predicted to grow 4%. So this is a stock that's even below the pace of the economy, if you ask me, or just at the pace of the economy, right? They need to find a new product segment, a new locomotive in order to grow fast. They need to find that. So that's Apple for you. And what else can I look at? Well, what I look at is gross profits. Gross profit is very, very, very important in the EV over gross profit or revenue growth. I rate gross profits. And if you look at gross profit, you may notice that Tesla is kind of an outlier. Tesla has 26% gross profit. And some calculate lower. I calculate about 26% when I take multiple quarters. So 26% gross profit. Well, that means the gross profit of 26% is the lowest. It's the lowest out of all of the three. But one of the bets that I think one makes when they invest in Tesla is that gross margin expansion. As more and more people are going to take a greater share of the software of Tesla, which is the full self-driving software, those gross margins should get, in my view, much closer to a Apple-like type gross margin, where you see Apple is at 43% gross margin because Apple does both hardware and software. The hope is that Tesla is going to have a larger share of software in its margin, and then of course if you were to nearly double that gross margin, you would get a stock that would be twice as cheap in my spreadsheet. And I don't predict that out over 5 years, 10 years out, but when you start predicting over 5 to 10 years out that the gross margin may double for Tesla, you get very impressive returns in my view. So this is why Tesla is my number one position. It is the only stock that I own out of all of these, aside from small positions in Google and Amazon that I consider savings account type stocks. So I consider them like cash. I don't consider them in my hypergrowth portfolio. As far as hypergrowth stocks, I only look at Tesla in this. I used to own NVIDIA. I've sold it. I've made a video about that a month and a half back. It may have been a mistake to have sold NVIDIA, but I sold NVIDIA because the growth to me is too uncertain. But with the guidance that we've had to Tesla, with 50% guidance, we're well on track for that. So I'm very happy to have Tesla as, in my view, is the most attractive of the Magnificent Seven stock. The last thing I wanted to say is, of course, EBITDA, which is a proxy for cash flow, which is what a lot of investors care about. And frankly, when you look at all EBITDAs, you see that they're not that attractive because you're buying equities, right? So there's more volatility. So they're not that attractive aside from Google and Meta, where you get an EBITDA yield, so the equivalent of a free cash flow yield, roughly. You get that equivalent to, say, a bond, a risk-free bond or a low-risk bond. You get about the equivalent at 6%. So those I see could be tempting to some folks, but in general, when I look at those EBITDA and those EBITDA yields, I see no great deal whatsoever. These are not stocks that you would buy, in my view, for the cash flows. You would not buy those stocks for the cash flow, in my view. There's much better opportunities if you're willing to go in stocks that have market caps between, say, $10 and $100 billion in market cap. You have much better opportunities as far as free cash flow yields, and I've covered a few on the channel that both grow and have tremendous free cash flow yield, like StoneCo, for example. But note, and this is the last point I'll make in this video, note how typically when you have a lot of revenue growth, you're also going to have a lot of EBITDA growth. And so over the long run, those yields should very, very, very much grow. Those EBITDA yields should grow as companies take on more revenue. So this is why when I calculate predicted EBITDA growth for companies like Tesla and NVIDIA, you can see they increase tremendously, plus 38%, plus 52%. So if you compound that growth on cash flow, and if you assume that cash flows are going to keep growing, kind of a price to earnings growth, except I don't use earnings, I use EBITDA. If you compound that, you are getting stocks that quickly would become very appealing to value investors if it were not for their stock prices going up. And in my view is that these stock prices are going to go up as the ratios. If you look at the ratios, the ratios do not tend to move that much compared to how much the revenue grows, right? Revenue can do a 5x, a 10x. As far as the ratios go, the ratios are typically range bound. You have a range on the ratios, and sometimes the ratios are 50% higher and 50% lower, but they're usually range bound and pretty stable over the long run. So, conclusion of the video. This video was mostly there for you to see the spreadsheet and see the valuation. Tesla is still my favorite play out of all of the Magnificent Seven. A second favorite play, maybe NVIDIA, even though I got out of NVIDIA. And then I consider all 5 other stocks, the formerly named FANG stocks. I consider this to be more savings account type stocks that will do just like the NASDAQ and that will lead the NASDAQ, but in my view, they will not outperform a Tesla or an NVIDIA simply because of that outstanding revenue growth that these two companies have. And this was just entertainment. This is not investment advice at all. This is only entertainment. I appreciate your likes. I appreciate your subscribes. Thank you so much for watching and have a wonderful day.